Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today we'll be discussing the key events that have happened in the markets over the day, the key market events that are currently moving the markets, and of course we'll be doing some technical analysis to understand what's currently going on in the markets, and hopefully everyone will understand the current trends and identify trading opportunities. So as we all know, these sessions are purely educational. They are not financial advice. So you should always do your own due diligence and of course, practice proper risk management at all times. So hello, Methodius, and thank you for joining the session. I appreciate having you here. So before we make any progress, I would like to begin with a mic test. So if you can hear me clearly, can you type hi on the live comment section? And these will confirm that everything is working just fine. All right, so let's get things started. So the number one thing I want to talk about is the strength of the dollar. And as you all know, over the last 3 days, we have had consistent pressure where the dollar has been gaining against other currencies. So the dollar index was doing really well on Tuesday, made quite some good rally. Following day on Wednesday, made a continuation of that rally. So it managed to break a major trend line that was holding as the resistance. And now we are headed to the previous high, a high that we last saw on the 3rd of this month. So today, we have seen a continuation of the same. So at some point in the middle of the day, there was some form of pullback before the market continued moving higher. So what has been fueling the strength of the dollar is quite a number of factors, among them the GDP data that was released earlier in the day. So the US advanced GDP quarter over quarter came in as a big surprise as the market was expecting a growth of 4.5%. And this was in the 3rd quarter of this year compared to the 2.1% growth experienced during the 2nd quarter. So this was a big jump and the surprise was 4.9%, meaning that the US economy is much stronger than expected. So with GDP moving close to 5% for the quarter, it basically means that with a very strong and healthy US economy, then the Fed may have to do a lot more to slow down the economic growth. So what we are currently witnessing is some of the factors that the Fed started out to basically control and get them back in control, being continually resilient. And this basically started in March 2022 or last year. So at that moment in time, we had this position where the US economy was really hot. There was a lot of money in the system, and the Fed was afraid that inflation was rising too much and they needed to do something. So at that point, US interest rates were currently at around 0.1%, and the US 10-year bond was yielding about 2.1%. So since then, the US interest rates have increased to 5.5%. Inflation continued rising, peaked in July last year at 9.1%, dropped to a low of 3.0% before it started rising in the last 2 months from 3.0 to 3.2, and then later 3.6%. So with this in mind, we know that the Fed had a number of set objectives. So when it started the quantitative tightening sequence, first, they wanted to slow down economic growth. And as you can see from this GDP, I don't think they are currently being successful with that. GDP is pretty strong, meaning that the Fed is not achieving that purpose. They also wanted to soften the job market, which was standing at a 40-year low of around 3.4%. But then the US unemployment rate has not moved much. So it moved to 3.5 and then 3.6%, which is still slightly close to the multi-year lows. And it basically means that the US is at full employment. So the job market is still tight and wage growth is still a problem because whenever you see an economy experiencing high wage growth, basically means that people have more money to spend. They buy more products, the producers produce more goods, they pay their workers higher, and prices generally increase across the economy, leading to higher inflation, which always have bad impact on consumer budgets. So the same thing we're experiencing here in Kenya, where inflation is on the rise, prices are rising, so workers are demanding for higher salaries. And when companies pay higher salaries, then they source this money from pricing their products higher, which basically creates that sequence, or we call it wage growth spiral, where wage grows up and then prices go up, and we keep having that spiral, which leads to an ever-rising inflation. So in order to tackle this, the Fed has been rising interest rates. And the last time we saw the Fed decision, they held interest rates at 5.50%. So the next decision will be on the 1st of November, where potentially they could hike by 25 basis points and push interest rates to 5.75%. So on that decision, and following the projections that were made by the Fed on the last couple of meetings, they basically said that the decision on the next meeting will be data dependent, meaning that it will depend on the data they see from the economy. So the data we have been seeing is inflation rising, and that basically pressures the Fed to go for another rate hike. And then on the job market, we are seeing a much tighter and tough job market, where there's more employers looking for employees than employees looking for jobs. Then on the other front of GDP, they were looking for slow economic growth, but from what we are seeing with today's report, we are basically seeing a very strong job market. So what this means for the trader is that there's a high potential that the Fed may go for another interest rate hike. And this is why investors are betting on a very strong dollar. So what they're betting on is that the Fed may go for another interest rate hike, which would make very short-term bonds in the US very attractive. So a lot of people would literally go there or basically buy more bonds. And when they buy these bonds, which are yielding quite an attractive return, for the 5-year bond, it recently hit 5%. So if you just, if for the 10-year bond, it recently hit 10%. So if you just park your money in the US Treasury, you basically get free 5% from that investment. So shorter term bonds are yielding even higher. So investors are in very high demand of these treasuries because they have quite an attractive return. So if interest rates continue rising, then the yields keep rising, and we keep seeing more demand for bonds compared to other risky assets, such as equities as well as real estate. So in this case, when the announcement was made and GDP data came in at 4.9%, a lot of investors were betting that the Fed will go for another rate hike. And as a result of this, we expect that we will be seeing a much stronger dollar. So when people are buying more and more bonds, it basically means money goes to the US Treasury and people remain with their bond certificates. So as a result, there's scarcity of the dollar, leading to a strength of the dollar. So this explains why we are seeing a very strong growth in the dollar index. So with a very strong dollar index, then it has ramifications on other currencies. For instance, if you're trading pound USD, then you'd notice that for the last 2 days, the pound has been continuously rising against the dollar, save for the last couple of hours when the pound attempted to make a comeback upon hitting the support trend line. So it attempted to go up. This attempt did not go on successfully. And now you can see in the last couple of hours, we are seeing some pullback happening here. And there's that potential that if the dollar keeps strengthening, then we will be seeing this pullback continue here. So in USD JPY, this is a special case where the Bank of Japan has been practicing a policy or that we may describe as yield curve control. So yield curve control basically involves limiting the yield on the 10-year bonds in Japan, which tends to be quite wild and variant. But then if you limit it at plus or minus a number, then it basically means that it cannot go above a certain number or below a certain number. So at the beginning of the year, the limit was 0.5%. So if the bond yields were moving up and they got to 0.5%, what the Bank of Japan would do, it would basically buy or absorb or other demand above that. So if there's more and more people looking to buy JGBs or Japanese government bonds, and the yields were at 5%, the Bank of Japan would buy all those bonds. So by absorbing all the demand, it would maintain the interest rates at 0.5%, or basically the yields at 0.5%. So later on, after a period of time earlier this year, the Bank of Japan expanded this yield limit from 0.5 to 1%. That was more than that was a double number. So once we got to 1%, the result of this is that the yields continued rising, and anytime the yields get close to 1%, then the Bank of Japan keeps on buying the bonds from the open market. So right now, there is speculation that the Bank of Japan is looking to expand this limit to 1.5%, and this means that if the yields keep rising, as of today, they were trading at 0.88%. So if they kept rising and hit 1%, and the Bank of Japan expanded to 1.5%, then it would allow more people to buy these bonds because there will be a much higher yield. So that's one of the speculations that has led to the strong momentum in USD JPY as more investors are buying the dollar and selling the Japanese yen. But then we have had several instances where the Bank of Japan has been intervening in the currency market. So the first one was a Tuesday, 2 weeks ago, where the Bank of Japan intervened and forced the USD JPY to move further back downwards. So this led to a big sell-off, but then the market recovered because there is still a carry trade. So a carry trade is where investors are able to borrow from Japan, where interest rates are really low, at negative 0.1%, and then invest these in US treasuries, where they're getting yields of up to 5%. So in this case, there was a big sell-off when the Bank of Japan was basically buying the Japanese yen out of the open market, but then this did not have as much effect. So they did this a second time. It was not successful, and the investors kept buying. And now we have breached the proverbial 150 level. As you can see, the current price is 150.3. And earlier this morning, there was also another attempt to manipulate prices lower. So this attempt from 150.768, so the Japanese yen trading way lower at around 149.84. But then the market recovered immediately, and what we are seeing is a tug of war between speculators and the Bank of Japan. So as long as the Japanese yen continues losing to the US dollar, investors tend to be making more and more profit. But then also it's becoming a problem for Japan, where investors are having to pay more for imports. So for anything that Japan is importing, they are paying higher because their exchange rate is getting worse. So this is similar to what the Kenya shilling is experiencing. So for instance, if you are a person who imports products to Kenya to sell here, then you normally know that as long as the Kenya shilling keeps losing, for instance, from 2020, we were trading at 99, around 100 bob per dollar. And then today we are paying above 150. Then your import costs are rising, and you might have to implement that to your customers. And of course, if your demand is inelastic, then you lose more customers. So if your demand is elastic, then you lose more customers. So it's the same thing happening in Japan, and the Bank of Japan is worried about this, so it keeps on intervening in the currency market. So the last time this happened was last year, somewhere around October. And once the Bank of Japan intervened, then we had this change of direction, where the Japanese yen moved from 150 all the way back to around 127 before it started losing again to the dollar. So in this case, we are having this scenario where on one side, the Bank of Japan is looking to intervene. It hasn't fully committed to intervening and strengthening the yen. But then on the other hand, the policies that it's implementing, such as changing the yield curve control, are basically contributing to much higher exchange rate for the USD JPY. So for now, fundamentals are pointing to a direction of the upside, where the US dollar continues gaining against the yen. But then if the Bank of Japan intervenes, and by intervention, it basically means a very simple process. The Bank of Japan basically sells its US dollar bond holdings. It gets hold of dollars, and then it uses the dollars to purchase the Japanese yen out of the open market, which basically creates scarcity and strengthens the yen. So in this case, we are expecting the market continued going up with a big risk of the Bank of Japan intervening, which is not announced. It's an open risk that could happen at any given time. So as for the Euro USD, we know that we had an interest rate decision happening earlier today, where the European Central Bank decided to hold interest rates at the current level of 4.5%. So with Eurozone interest rates holding at 4.5%, oil prices rising, and of course, we know that general prices will also be rising, inflation will be rising in the Eurozone. And now we are approaching a period of winter where demand for gas tends to be highest. Then there's a high likelihood that the euro will continue suffering to the dollar because people can simply borrow money from the Eurozone and invest this in the US and get some good differential. So in this case, we expect that even though the Eurozone has not been able to hike interest rates, the US is continuously tightening policy, leading to a much stronger dollar, better yields on bonds, leading to a big sell-off in the euro against the US dollar. So in this case, we've had this strong bearish momentum. Market attempted to recover, forming higher highs and higher lows. So for the last couple of weeks, I can say that this high and then this high and this high, they're getting higher, this low and this low and this low, they're getting higher. But then from the price action today, you can see the attempted change of direction, where now what we are seeing is the market attempting to break lower, and now we could be headed for a much lower low, and this could change the overall outlook of the Euro USD. So there is a good chance we'll be seeing a very good change in our Euro USD, whereas towards the end of the week, we could be seeing the Euro USD attempting to retest previous lows in the last 2 weeks, as well as in the last 3 weeks. So there is a good likelihood we could be seeing some much lower prices, and this depends if the market retests this area and continues moving back downwards. So you have to observe the 1-hour trend line that is currently being observed and retested right here, and see if there's a bounce and the market fails to break this area, because the price could eventually get back downwards. So as for USD CAD, we have seen a clean break and the market moving even higher. So our projection was that this resistance would be tested. And so far, so good. What we are observing here is the market heading a little bit higher and attempting to retest this resistance at 1.38605. So the reason we are seeing this is that oil markets are weakening. And with weakening oil markets, it's coming from the earlier data in the week that showed that the manufacturing and services PMI in the Eurozone, as well as the US, they're weakening. And of course, we are also seeing the US negotiating a deal with Venezuela to basically lift the sanctions on their oil sector, which would increase the oil supply in the markets, leading to lower oil prices. So lower oil prices are correlated with a weaker Canadian dollar. So this would mean as long as the dollar continues being strong, then we could continue seeing this upward trajectory happening in USD CAD. So earlier in the day, when we were having the market snapshot series, we discussed the potential of the market moving back to retest this trend line and then eventually moving higher and getting to our target point of 1.38605. So far it's playing out well, and there's that potential that we could eventually get there. So remember, this was the previous resistance. So once a resistance is broken, it's common practice to see the market retesting the area before continuing in that direction. So as for gold, what we are seeing is a flight to safety. So last 2 weeks were extremely bullish for gold. And then this week, we have had this sideways momentum, but then gold is seemingly breaking towards the upper side. So Monday, we opened here, went down, up, and then down, and then up. Market got back down and then up, and then we broke that resistance for the week, moved higher today, pulled back downwards, and now the gold is looking to price even higher. So it's that area where you see the market moving sideways for 3 days, breaks upwards on the on the 4th day, pulls back, and then continues higher. And now our target towards the end of the day and the opening of tomorrow is that the market tests the high that we saw last week of 1997 and perhaps goes to the psychological level of $2,000 per ounce of gold. So our USD has been pretty strong today, making a very strong comeback from this support level. So if you zoom out, you'll notice that this has been a major support level and the market has been respecting it for a long time. And this is since the 17th of August this year. So having bounced from this trend line, we saw some good uh, acceleration from here. The market happened to slow down for a while for some part of the day, but as you approach the end of the day, it's seemingly looking shiny and it could be closing closer to the high of the day. So US equity indices have made the biggest news for the day, having been selling off for the better part of the week. So from what we are seeing here, the US equity indices, beginning with the NASDAQ, have already entered into what we call a correction territory. So if you're trading a US equity index and it's down 1% from its previous high, that's nothing to worry about. If it's down 2%, nothing to worry about. 3, 4, 5, 6, 7, 8, 9%, nothing to worry about. But then when the stock market is down 10% from its recent high, that's generally accepted as a correction. So from this area here, which was the highest price this year, to the current price that we are seeing here, the Nasdaq is now down 11.67%. So this means that once we breach the 10% pullback, it basically implied that the market has basically entered a correction territory. And now investors who are thinking about bullishness are now thinking about bearishness. So when this breakout happened, this was towards the end of the day yesterday, we continued dropping further downwards today. And then later on, we had this speculation that after a major trend line has been broken, the market could go back, retest the area before continuing with a bearish momentum. So far, it has played out well as expected. And as you can see from the current price action, it's some further downside momentum. And this is expected to continue perhaps towards the end of the month. So from the daily time frame, you can see these are clean breakout, market oscillating up, down, and then eventually breaking towards the lower side. So there's still more downside room for the Nasdaq. So we will be looking at this as a theme going forward, where we expect the Nasdaq to be erasing some of the gains that it had made earlier in the year. So now, the last time that we saw Nasdaq trading at this low was on 26th of May this year, and we could be seeing some further downside going ahead. So as for the Dow, we were expecting it to retest this support area here. And so far, from what we are seeing in the current candlestick, is the market attempting to cruise down lower. And if the market closes lower than that area, then it's basically a signal that the price is headed much lower, and investors are basically going for short selling positions. So it's the same thing happening on the S&P 500. So even if I zoom out to the 4-hour chart, you can see that the breakout happened earlier in the week, and now we are seeing a continuation of the same. And the S&P 500 is also approaching what we may describe as a correction zone. So from that high to the current price level, this is about, I'm trying to estimate, 10.35%, meaning that the S&P 500 is officially in correction territory because it's down more than 10% from its previous high. So this is usually a very important trigger for institutional investors, and now we'll be expecting some much lower prices. So as for Brent oil, this is what we are seeing here. A market that was basically going down for 3 straight days. Yesterday, it found some good support and narrowed higher, but then today we have erased those gains. So this means that there is a good chance that we'll be seeing some further downside, especially after we saw US oil inventories increasing. So with increasing US oil inventories, it means that there's more supply, which may lead to lower prices. And now, considering the idea that I talked about earlier, of the US lifting sanctions on Venezuela, then this would potentially increase the supply of oil in the markets, leading to much lower prices. So for the French 40 index and other European equity indices, they were quite bullish at some part of the day. That was around midday towards the end of the London session, but then they have continuously raised gains. So we expect some further downside momentum, especially in correlation with the American indices. And we have seen the S&P 500, the Nasdaq, and the Dow continuing to be selling off. So from what we are seeing here, even on the 4-hour chart, it's a bearish engulfing right here, leading to the speculation that the price will continue moving downwards. So besides that, if you look at the Euro 50 index or the Euro 50 cash index, then what we are seeing here is the market that attempted to go up, pushed back downwards, and now the speculation is that the price could continue moving further downwards. So also, if you look at the UK 100 or the FTSE 100, it's just about that point where it's breaking just below. So in the last 1 hour, there was a break below this support, and now we are headed much lower. So in this case, the expectation is that the price continues moving downwards, and short selling positions may surface in this particular market. So remember, we are still on a downswing. We haven't hit support yet. So there's still more room for downside momentum before we find support in the UK 100 or the FTSE 100 index. So on the other hand, if you are a person who prefers trading Bitcoin, then we know that Bitcoin has been moving higher for the last couple of weeks. And then this week, all we are seeing is sideways momentum. So today being Thursday, we are seeing the price of Bitcoin breaking towards the lower side, breaking here, retesting and moving further downwards. This is Wednesday and Tuesday. And now there's that belief that once you've broken below that flag, there is more room for downside momentum. So Bitcoin is basically attempting to make a pullback. And I believe there will still be some good room for downside, having seen this breakout happen towards the lower side. So among other pairs that have been trending in the markets today, we have seen the New Zealand USD attempt to make a recovery, and it's continuing as we speak. So despite the strong dollar, we are seeing the New Zealand dollar being quite strong, and now it may make sense to target some of these areas along this trend line. So there's still more room for some upside in the market could get to this area here. But then, if you look at the USD trading against the Swiss franc, it's currently pretty strong, making a recovery after having broken out of this trend line. And if I was to use a different data point, let's say use the highest point of the chart, and then we try to analyze these, then it's very clear that the market broke towards the upper side and is now headed higher. So with the USD trading higher against the Swiss franc, then we are currently at a critical level that was acting as a support. And of course, the next target point seems to be the previous high that we saw 2 weeks ago at 0.90892. So the German stock market index is still pretty strong. And we could be seeing something different from this compared to the other indices. Pound yen managed to make a very strong bounce here. So as per my analysis, I expected some form of breakout to happen here if the Bank of Japan was to intervene in the markets again. So since this has not happened yet, then all technicals are indicating to some further upside momentum. So there is a good likelihood that if the Bank of Japan doesn't intervene, then we could be seeing some further upside. And of course, the previous high is around 183.042 Japanese yen per pound. So pound against the Swiss franc is also making an impressive comeback. So we could also be seeing some further upside, especially after the big sell-off that we saw last week. So CAD JPY, the Canadian dollar is pretty weak. So the Japanese yen is making quite an impressive run. So all I would say is that after this particular level was broken, market pullback is now breaking towards the lower side, then there's that high likelihood that we will be seeing some much downside momentum. Perhaps you could also test 108.014. So I remember earlier in the week sharing a signal in Euro JPY. The market had found a resistance here, and then the euro continuously rose against the Japanese yen, eventually hitting the target earlier today. So from what we are seeing on the trend line is a market that has been finding some good support around this area. But now we have quite a number of candlesticks trading below this trend line, which implies that there's more momentum towards the downside. So in this case, expect some further downside momentum happening from Euro JPY, especially if the Bank of Japan was to intervene in this market. So the failure of the ECB to hike interest rates early in the day basically means that the investors are questioning the move and are basically trading based on a weakening euro. And this could continue being a theme for the rest of the week. So anyone who is finding a very strong asset and buying it while selling the euro they might find some nice opportunities going forward. So while the Japanese yen is weakening, then the Nikkei 225 index is also experiencing a similar kind of sell-off. And now we have basically found a support that was held on Tuesday and then broken below that, which basically implies that there's more room for downside for the Japanese Nikkei 225 index. So you could be seeing some further downside getting to 30,285 price level. So I'll be checking on your questions to see if there's any questions or comments before we approach the end of the presentation. So hi, Francis. I can see Malombe in the house. FX Apprentice, Karosha Chieng, Kenneth, J Squad. Where is the dollar stuck at the current price level? The dollar is headed higher. That's guaranteed, especially after we saw a very strong GDP. So please, can you share your Telegram channel? I think this is the second time I'm seeing this request for the day. And I'll share something. If you go to Twitter, search Rufas KE, you'll find my official link on my bio. So all you have to do, just go to my Twitter. You'll always find the link on my bio. But since you have requested, I'll be sharing the link right here on the comment section. So this is my personal Telegram group. It's not affiliated with FXPesa in any way. So always be mindful and take care of yourself while you're in the group, because since it's an open group, you might also interact with people who might be looking to scam you. So always protect your personal information. Hello, Willibet. Thank you for joining the session. You can see Vinny Langat in the house, who has invested in this thing and got profits during first attempt. In Forex, you don't invest, you trade. We are basically speculators. So we identify trading opportunities based on either fundamental, technical, or sentimental analysis. And if our analysis indicates an asset is going in a certain direction, you risk a certain amount of dollars. And if you're right, you make a certain amount of dollars. So we don't generally hold for the long term. We are major speculators trying to identify the market direction. So what is the importance of saving your money in USD account? Of course, the problem is that the currency we have locally, the Kenya shilling, is continuously losing to the dollar, basically meaning that you're losing your purchasing power. So if you had some money stacked away in 2020 at, let's say, $100 shillings per dollar, now you're getting fewer dollars because you'd have to spend around 156 to 160 to buy the same dollar. So this basically means that as long as you keep holding the cash shilling and the economic conditions don't change, you keep losing your purchasing power. So this means you might have to buy assets that appreciate in value or tend to store value strongly compared to the shilling. So Euro or JPY, Euro is weakening to the dollar, the JPY is weakening to the dollar. So you might consider the USD as a more superior currency compared to the other currencies. Where do you know where to trade when wanting to trade on Forex? This is a really good question. So normally, every day from Monday to Friday, we have this very interesting session called Market Snapshot Series. So the Market Snapshot Series, it happens live on YouTube at 11 a.m. Monday to Friday. This is where we basically tell you these are the key events for the day. These are the key developments on the previous day. These are the key market structures that present a potential trading opportunity. And then from that information, you can easily narrow down to a trading opportunity. So if you want to know what to trade and where to focus your energy on for the day, then it's very important that you basically attend the Market Snapshot series. And this basically helps you narrow down to a trading opportunity. So tomorrow we'll be having a very interesting session presented by Samson Mzera, all the way from Eldoret, and he'll be sharing a market analysis of currently what's happening in the markets, the data that was just released today, what we'll be expecting for the day, and of course he'll be doing some chart technical analysis to identify potential trading opportunities. So thank you very much, guys. Thank you for your time, and I hope to see you on the next session. Thank you, Douglas and Wafula. Thank you, Francis. I appreciate all of you guys.